explain this capital allocation line, the generation, the origin, from where it originated. For that, I am taking the example of a case study. Supposingly, there are two portfolios. Supposingly, there is a portfolio, risky portfolio, consisting of two securities, A and B, and let the name of that portfolio is X, and we have calculated the weights as per minimum variance portfolio frontier and as per efficient frontier, which I have already told you that how to calculate the weights. Those can be calculated with the help of minimum variance frontier. So just write down case study for my sake. Write down, I have prepared for you. Following is the information in regard to two assets A and B in a portfolio X selected as per minimum variance frontier or / efficient frontier with given weights. Now supposedly this is a portfolio which is there, risky portfolio X, security A and B, and we are given with how much is the return of A and how much will be the return of B. Standard deviation we are given with, correlation we are given with, weights we are given with. I have put tick 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 tick. Now this we have already calculated with the help of minimum variance portfolio. Now suppose an investor wants to build a new portfolio, because I have told you that in case of a rational investor, he will be interested in investing some part of his funds, allocating some part of his capital to risk-free. So suppose an investor wants to build up a new portfolio Y. Let this portfolio be Y. Let this be portfolio Y. Now portfolio Y consists of two. Portfolio X, that is which consists of A and B or TCS and Infosys, and that risk-free asset. And in portfolio X, let 70% be the weight. Within that 70, we have divided between 80% to Infosys and 20% to TCS, as the case may be, and 30% to risk-free. Please prepare a graph. Please prepare the diagram. Please prepare this case study. I want to tell you with the help of case study what is the meaning of capital allocation line. Now I'm moving step by step. Now new portfolio Y. Now it consists of two portfolios. Now it consists of two assets. One is portfolio X, which again consists of two A and B, and second is risk-free. So I have prepared a graph or the flowchart for you so that you can get an idea that what is the meaning of new portfolio. Now suppose following information has also been specified. Supposingly in TCS and that Infosys, I have already told you how I can calculate 11.4%. So now in this, let the 11.4% instead of 11.4%, I have written 10%, but I have told you the method how to calculate 10%. So I have calculated the expected return of portfolio X, which consists of A and B. Let the rate be 10% and the standard deviation be 8%. Risk-free asset, we know that return is always less in case of risk-free asset, so let it be 6%, and standard deviation is 0. Standard deviation is 0 in case of risk-free asset as per Harry Markowitz, and the correlation between portfolio X and risk-free asset will be 0 as per Harry Markowitz. We know that. Now, expected return. Now, how to calculate expected return of a portfolio Y? I can easily calculate because I know that 70% I have invested in portfolio X and 30% I have invested in portfolio in risk-free assets. So that comes to 8.8%. Now the question comes. Now the picture will start. How to calculate standard deviation of portfolio Y? Now, when I say a standard deviation of portfolio Y, I have written that longer formula, that A plus B whole square into correlation between A and B. But I know that risk of a risk-free asset, standard deviation of risk-free asset is 0. So, if this figure is 0 and this figure is also 0, then we are left with this figure. And because it is whole square and it is this, so I have crossed this. So the net result is standard deviation of a portfolio which consists of risk-free asset, that is standard deviation of X into weight of X. As for the mathematics, I can write down. Now this is linear equation. Now this is non-linear equation. So with the help of introducing risk-free asset, I have converted a non-linear equation to linear equation. Now it will ease my task. Note 1, please write down note 1, very important. The implication of adding risk-free asset in the portfolio is that relationship which was non-linear. The relationship which was non-linear earlier has been converted to linear equation. By introducing risk-free asset, we know that standard deviation is 0 and whole anything multiplied by 0 will be 0. So B square and 2AB into RAB, that all will be 0. We are only left with A square under the root and square I have crossed. So I am left with A, and A is nothing but standard deviation of risky portfolio into weight of risky portfolio. So this is linear equation. So that the thing I have written in note number 1. Hence, due to linear equation, this linear relationship is due to linear relationship, I have prepared a graph, a line which is named as capital allocation line. And capital allocation line is starting from this, because an investor will 100% be investing something in a risk-free portfolio, risk-free asset also. So this is risk-free. He will start from here, and then risky. This will be the risky portfolio, and this whole line, this straight line, will be named as capital allocation line. So this is a concept from where capital allocation line has been generated and how it is converted to a line. Now, when I say a line, it means a linear line. When I say a linear line, it means something is in LHS and something is in RHS. That is no square root, no square. That is a linear line. That is named as a linear equation. So, up to this point, I have just told you by introducing a risk-free asset, we can convert, non-linear into linear, and that line is named as capital allocation line. Now, what is the meaning of capital allocation line? I have already ask something from Google Baba. Now see the Google Baba. This is capital allocation line. Now you see these lines are starting from risk-free rates. These lines are starting from risk-free rates because investor will be investing in risk-free. These lines are starting from risk-free rate. This is capital allocation line, and it will be a straight line now because it will be a straight line because it is a linear equation. You're getting a point? It is a linear equation. So like this, I have told you what is the meaning of capital allocation line and why it is a straight line and why it is starting from risk-free rate. Now, I will be telling you something more about now. Now, the next point in this capital allocation line will be lending portfolio and borrowing portfolio. Just see the graph. That line, lending portfolio and borrowing portfolio, left-hand side of this M is lending and right-hand side of this M is borrowing. Now, what is meaning of lending and what is the meaning of borrowing? That we will be telling you. So, firstly, for that, just write down something. What is the meaning of lending portfolio? In case investor invest in left hand side of risky portfolio. Now what is risky? This is risky. The middle point of this is risky. This is risky portfolio. This is risky portfolio. This point is risky. If he invest in the left hand side, then this will be lending portfolio. If he invest in the left hand side of this risky, that, or I can say if an investor is investing in the left hand side of capital allocation line, it means he is investing in risk free asset as well as in risky assets. And if an investor is investing in the right hand side of this risky portfolio, then I will say he's borrowing from risk free and investing more in risky. Borrowing from risk-free and investing more in risky. So this portfolio will be named as, right-hand side will be named as borrowing portfolio and left-hand side will be named as lending portfolio. Just write down, I will explain it again. No need to worry. Just have an idea. Lending portfolio. In case an investor invest in left-hand side of risky portfolio. In case an investor invest in left-hand side of risky portfolio. That is investing into government bonds. By investing left hand side of CL, we will have less return and less risk. We will have less return and less risk because we are investing in risk free. So we will have less return and less risk. But if we are investing in right hand side, that is a borrowing portfolio that I have X rupees, but I am investing in the market as X plus something. And that something I have borrowed from risk free. So just see borrowing portfolio. In case investor invest in right hand side of capital allocation line, then it means borrowing portfolio. If own funds are this much and we have invested $12,000 in the risky portfolio, it means $2,000 we must have borrowed. So please prepare the graph. I will assure you that you will be able to do all those practical problems in case you have sincerely you have listened to my lecture. Now the point is, on x-axis, I have taken, standard deviation of a portfolio. On y-axis, I have taken expected return of a portfolio. And this line will start from risk-free rate. And this whole line will be named as capital allocation line. And on the left-hand side will be named as lending portfolio. And on the right-hand side, it will be named as borrowing portfolio. And what is borrowing? If we are borrowing from risk-free and investing in that risky. And what is lending? What is lending? If we are investing in risk-free as well as in risky, as I've just assumed in portfolio wide. So there will be less return and less risk in lending portfolio, and there will be high return and high risk in case of borrowing portfolio. So this I have discussed something about capital allocation line. Now I have prepared a helicopter pad, a brief history about capital allocation line, minimum variance frontier, efficient frontier, how we will calculate the weights. Now we will use these numbers in the coming learning outcomes, and we will enjoy like anything. We will use these numbers and we will play, and whole concept will be clear to you. Be happy, be jolly, be cheerful.